Now our favorite topic of Asia with a focus on China. So here we're going to start to cover some of the data that's come out since the end of the Communist Congress. But one of the key ones that I thought was interesting was the budget deficit. And this is a key component because when you talk about China, there's always a view of, onshore debt, it's fine. But their debt is getting worse and worse. So look at China's augmented budget deficit hits nearly $1 trillion in January and September. Now, the problem is, and again, you could point to budget deficits everywhere. This is not new. But the bigger issue with China is their reliance on exports. And as a percentage, it's gone down, but that keeps moving lower. Because when you look at just moving down, but it was, I think, 27%, and now it's about 15% in general. And as that 15% continues to dwindle, just under normal economic slowdown, that's going to become a bigger problem because if you flow back on the export side, how much of this is created internally? How much of this is a backdrop of intermittent goods, raw materials, processing? So much of this is driven for, China being on the manufacturing side, that slowdown in exports, that slowdown has a much bigger reverberating factor, which is why they've increased their budget deficit so much to try to backstop. They've issued tax cuts. They've issued, rebates. They've issued rebates on VAT taxes, other types of things to try to bridge the gap. And as it continues, they already had a massive leverage ratio, which is only getting worse. The recent rumors. So I'm sure everyone has seen the zero COVID policy. So the claiming imminent relaxation of China's zero COVID policy. On Wednesday, the zero COVID signal we have all been waiting for since the conclusion of the 20th Party Congress finally came. China's commitment to zero COVID remains unchanged even with the Party Congress done and over. So there's been a lot of conflicting data, but the signal came at a leadership meeting of the health minister to study the outcomes of the party Congress. The NHC chief Ma spoke at the meeting. According to the meeting readout, unswervingly adhering to the dynamic clearing overall policy, striving to control sudden outbreaks with the smallest scope, shortest time, and lowest cost. So that's the exact same language that has come from the containment policy, literally word for word before the party Congress. So as much as I know people are looking for reasons and saying, okay, this is it, like they're gonna wake themselves up, look at budget deficits, they're getting worse, they have to get their economy back, but they still have a need for control. And it's become a narrative and it's become a point of pride of how China has handled the COVID spread versus everywhere else. Because I'm pretty sure at this point in time, if you were in Europe, if you were in Latin America, if you were in North America, you have had COVID. I don't know anyone off the top of my head. I cannot think of a single person that has not had COVID. In China, they can say that. And that's something that has been a point of pride. So, at what point does the economy overarch protect where things are? And again, that's the unknown in general. So, China's zero COVID policy remains the same. Recent days, rumor mongers took advantage of the complete silence from the central government. They were largely successful because investors, key point, hate the zero COVID policy. But if you watch some of the big mouthpieces, both on the corporate side and the government side, have been very adamant about protecting the Chinese people from long COVID effects. And then for those that don't know, long COVID is trouble concentrating, difficulties breathing, other types of lung damage. That has been called long COVID, and they're saying that they're trying to go about that. So again, it's just be prepared because we're going into winter, and we all know just because it is a coronaviruses love to spread in winter, and that's going to be one to watch as we go forward. Now, when we look at some of the recent data sets for the Contraction Chinese Service PMI, expected to be at 49, came in at 48.4. we continue to see the slowdown, and it's not getting any better. It's just accelerating to the downside. And that's why we don't see a huge pivot, as we talked last week, looking at, again, credit impulses, other types of expansion is a significant problem when you look at Chinese growth, because the bigger issue is trying to get a lot of these policies all lined up. So some of the key things that we've seen, and again, this is important because they're going to try to address the economic slowdowns. Hu, who was once considered a potential Xi successor and who many had picked to become the next premier, not only failed to make the PBSC, he dropped out of it altogether. The new PBSC members of Li Kang, Kai Qi, Li Ji, and Ding Xuanzhang are all Xi's confidants who have worked alongside him for years. So he has been able to consolidate a lot of these powers in the PBSC or the standing committee. But some of the key components are going to be, well, what do they do with that? So in July 2021, at the height of Xi's tech crackdown, the so-called double reduction policy wiped out the value of Chinese educational technology. But now, where are they going to double down on signature policies? And the ones that have been called out the most is common prosperity. That is the one that we've highlighted. It's going to be top of the list of things to watch, because there has been a lot of concern of foreign entities, of foreign companies, of, well, what does this mean? Are you going to take profits, redistribute it? What is that going to do in general? And I think that is going to be a big problem. Then you look at zero COVID, face less opposition within the party, and be rolled back. Xi will go all out in pursuing the innovation drive, and bottom line, business and investors will face a more uncertain Chinese environment in Xi's third term, especially because this is his third term. This is unprecedented. So he feels he's going to feel emboldened, especially with the fact that he was able to solidify the PBSC. And he's going to be able to drive that going forward and really put the pressure, which unfortunately, it's happening at the worst time, because Chinese manufacturing PMI was expected at 49.8, came in at 49.2. New orders, back to what we were talking about at the very beginning with exports, is down to 48.1. Again, a meaningful drop in contraction, which we only see getting worse based on those leading indicators of new export orders, intermediate goods, the shipping data that we've seen in terms of the slowdown for this year and into next. China being such a big exporting nation, it's going to hit hard. China non-manufacturing PMI was expected at 50.1, came in at 48.7. And then employment on the PMI manufacturing side is in contraction. But look at it since 2017. It has always been in contraction. As we've been talking about, there has been that pivot in that shift to not so much onshoring or nearshoring, but getting and diversifying away from the Chinese supply chain. Still in Vietnam, Bangladesh, India, Pakistan. But again, you're seeing some of these pressure points where that employment number has been contracting and continues to be a huge overhang. But it's only getting worse as the PMIs are going down. And then the budget deficit. The budget deficit, it's a communist nation. So everything falls to the party to make sure everyone has a living standard. So when you look at the employment side and you have more people that require support, that is going to increase cost and increase the strain on the underlying government. Non-manufacturing PMI, 46.1. Look how extensive this is. I mean, this is a massive contraction. And if you think about the natural maturation of an economy, you go from farming to manufacturing to services, and that non-manufacturing has failed to show. So then when you look at the share of Texas Teacher Pension Fund emerging market portfolio and some of the key components going forward, and again, this is just picking on them from the Wall Street Journal, you're seeing a huge consolidation and a cut in the amount of money being designated for China, which is only going to take, again, foreign investment out, is going to slow down their availability of capital. A lot of this pension money is sticky money, and it's looking elsewhere. If anyone knows them and they need a place to put their money, I'm looking to raise money. I would be happy to take their capital and deploy it within North America along a green solution across multiple different avenues of energy infrastructure. But that is a conversation for a different time. Now, when we look at the credit impulses, as we were talking about, China will not come to the rescue because, again, look at the credit impulses. And this is with a huge push from the PBOC, from the CCP, to drive additional credit. There is no demand for it. Marginal propensity to spend indicator for households and non-financial enterprises are steeply negative. You are looking at a contractionary point with just how willing are people to spend given the economic backdrops and those unknowns. U.S. non-oil import prices, Chinese PPI. The PPI side has come down, which is a positive when you're thinking about inflation, but deflation is its own enemy in a different way because you're seeing, again, that growth and that capitulation where everybody's just like, look, I'm not doing anything. I'm just going to sit on my hands. And when you look at the credit impulse side, everybody is already so levered. There is no demand to take new risk, to take new debt. And again, if you look through the last 25 some odd years, credit impulses has been the biggest way that they have propped up the economy. Every time exports slow, infrastructure spending, which all have created this huge surge in these credit impulses. But you look at it, each time they go up, it's less. It doesn't go as high. It doesn't go as high. And now, this is what we've been talking about. This has been our crux of the point since February 16th of 2021 was that this is over. They don't have the ability to generate the same benefits as they have previously. And that was when you started to see that really big drop. And our whole thing is PBOC wants this. They want the credit impulse to go negative. They want to take some of the liquidity out. But our point was that when they try to reinvigorate it, there just won't be anything there to do it. Now, when you look at South Korea CPI, again, expected to be at 4.5%, came in at 4.8%. So you look at Japan, which is over 2%. You have South Korea going higher. And South Korea has been raising rates while Japan has held firm, not raising rates. And it's just a matter of time before Japan blinks, or as Gary put it, gets poked in the eye and has to blink anyway. But the force is going to be they're going to have to change their directive and their drive in order to fulfill their needs. The fiscal commitment to infrastructure development, when looking at Japan, you can see just the underlying shift in terms of central banks and state governments. The fiscal, this is China, I apologize. When you look at the central government, state government, there's still that demand of trying to get that expenditure out, and it's just not being successful. Now, retail sales, when you look at retail sales on the Japanese front, so retail sales values have gone up while volumes have come down. And that is just showing just in general, when you look at the Tokyo CPI, ex food and energy, expected to be at 2%, came in at 2.2%. This is the problem of why I think the BOJ is going to have to blink and change strategy. And it's going to be a very interesting ride as we continue down this path. So that's what I have for you today on the Asian side. It's a little bit shorter. We'll have a bit more coming up as more Chinese data comes out and we get more clarity on common prosperity, Xi directives, because that's going to really set up the next several years of his stint as president. So that's what we have for you. We hope it was helpful. If you have any questions, please let us know. And again, thanks for watching. I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.